This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Red hot, Amazon and Alphabet blow past earnings expectations as the tech-dominated NASDAQ pushes further into record territory.
Passenger policies. United settles with the man dragged off its plane and takes more steps to try and improve its battered image.
Drowning in debt, Americans owe a lot of money, and the amount is growing fast. But how much is too much? Those stories and more tonight on Nightly Business Report for Thursday, April 27th.
Good evening, everyone, and welcome. The NASDAQ closes at a record, and the way things shaped up late today, that index's hot streak may only get hotter. Let's start out with Amazon. The online retailer reported strong quarterly results, blowing earnings estimates right out of the water. The company reported a sharp rise in profit, even as it spent a lot on expanding its operations overseas. Here are Amazon's quarterly numbers for you. It earned $1.48 a share, 36 cents better than what Wall Street was looking for. Revenue climbed from a year ago and also topped expectations. Investors liked what they saw, sending shares to a record in after-hours trading. Deirdre Bosa has more on the results.
$1,000 is the next big number to watch for Amazon. Blowout results pushing its shares within striking distance of that milestone. Now, the company is pushing into a dizzying array of new businesses and regions and investing huge to do so. This quarter alone, it increased its presence in India, spent big on video content like its partnership with the NFL, boosted its logistics business, and introduced new features and eyes for its hit Echo device. Now, despite the heavy spending, though, Amazon is making money too, thanks to continued growth in online retail sales and its profitable cloud business. For Nightly Business Report, I'm Deirdre Bosa, San Francisco.
Alphabet also out with a very big quarter. The parent company of Google saw a surge in ad revenue as it competes with Facebook to grab a larger share of this fast-growing market. Its YouTube business also strong, despite some brands recently pulling some ad money because of placement next to controversial videos. Alphabet's results topped earnings and revenue expectations. Look at the chart there. Saw shares rise in initial after-hours trading. Josh Lipton now with more on the company's big quarter.
$21.4 billion. That was one big number in Alphabet's latest earnings report. It refers to Google's advertising revenue. And again, this is how this company does make money. Some investors had expressed concern, though, heading into this report. Remember, in late March, some big brands had suspended campaigns on YouTube, and that was after ads were running alongside some offensive content. Google responded, implemented some new controls and policies to safeguard those advertisers. In a quick chat with a senior executive at Alphabet, they said that from a revenue perspective, the near-term impact from that controversy would, in their words, be modest, and that long-term they would continue to benefit from the secular shift in how consumers are indeed consuming content. Investors certainly look pleased with the results. For Nightly Business Report, I'm Josh Lipton, San Francisco.
And while investors liked the results from those newer tech companies, they were disappointed by old tech. Microsoft's earnings topped expectations. Its revenue, though, slightly missed due to weak growth in its personal computing business, its largest unit by revenue. The bright spot was increased demand for the company's cloud business. Shareholders expressed their disappointment, though, sending shares lower initially in after-hours trading. Julia Borston has more on Microsoft's results.
Microsoft's cloud services driving better than expected results. CEO Satya Nadella saying of one of his most important initiatives that from large multinationals to small and medium businesses to nonprofits, organizations are using Microsoft's cloud platforms to power their digital transformation. Microsoft's Azure cloud product saw 93% growth in the quarter, while its productivity and businesses process division, which includes Office 365 as well as cloud services, saw a 22% increase. Back over to you.
Julia Borston reporting there. And then there's Intel, the world's largest chip maker, reported lower than expected revenue. Its data center business, which is crucial to Intel's transition from the PC market to internet-connected devices, did not do as well as many had hoped. That said, Intel's CFO said he feels good about the quarter.
The data center business performed right in line with our expectations for the full year. We're looking at 8% growth for the year, and 6% is what we expected in the first quarter, and we feel like we're well positioned.
He may have been satisfied. Investors were not. They were disappointed, pressuring the stock in initial late-day trading.
So lots to talk about. Let's turn to Dan Morgan now for more on how these big tech names and their results might impact today's record-setting NASDAQ. He is Senior Portfolio Manager at Synovus Trust. Nice to have you with us, Dan. Welcome.
Hi, Sue.
You know, an awful lot of big names out with their earnings today, and the NASDAQ sets a record high. There are those who say the NASDAQ is looking a little frothy. Others say, nope, with results like this, it can power higher. How do you feel?
Well, if we look at the NASDAQ composite right now, it trades at about 33 times earnings. S&P is about 21 times earnings. But if you look at expected growth, Sue, going into this year, the NASDAQ is like 53% compared to the S&P 500 at about 11%. So I think that the multiple commensurates the expectations in terms of earnings growth. The other point is you have to just remember we're only 1,000 points above where we were in March of 2000 when the NASDAQ hit 5,000. So we're not that much higher than we were 16, 17 years ago.
So what's driving the NASDAQ? Or is it the names like the ones that reported today, the Alphabet and Amazon, or is it ones that fly a little bit below the radar screen?
Well, one area that wasn't on the platform today was the semiconductors. They have done extremely well. That is an area that has really been doing well within technology, within the NASDAQ. Apple will report next week with their expectations on iPhone 8 or getting ready for that. Those are some other reasons that have really been pushing the NASDAQ. So it's been other names, Tyler, than just the names we're talking about today, which is obviously Amazon and Google with huge numbers.
You mentioned in the notes that I'm looking at here that the Commerce Department is going to report the GDP number tomorrow, and that we've seen business investment in software and business spending in software drop off a little bit. Do you anticipate that that will continue? And how worrisome is that for you?
Well, it is somewhat worrisome, Sue. I mean, if you look at last quarter, it was down 4.8%. If we got another bad number tomorrow on, business investment and software spending, that would give us some, concerns that going forward that, growth in technology spending may be slowing, and that's something we have to be worried about within the NASDAQ composite.
What's your favorite tech stock and why, Dan?
Well, like Amazon a lot, just because of AWS, Amazon Web Services. It was up 42% growth on their cloud unit.
That's pretty good.
I think that's kind of the gem there with Amazon. It's done really well. That's probably one of my top technology stocks right now.
All right, Dan, we'll leave it there. Thank you so much for joining us tonight. Dan Morgan with Synovus Trust.
Well, the tech sector helped lift the broader market during the trading day, offsetting a decline in energy shares as investors shifted their focus from Washington back to the health of corporate America. The Dow Jones Industrials up 6 points to 20,981. NASDAQ up 23 to the record, as we reported earlier. And the S&P 500, it was up 1 1/3.
So we are now at the halfway point of earnings season, and some positive trends are emerging. Bob Pisani takes a look.
We're more than halfway through earnings season, and so far, the market likes what it's seeing. Now, stocks have rallied this week on a combination of lower geopolitical worries from the French election, long-awaited tax cuts now in play, and this is perhaps the most important thing, earnings guidance that has generally been better than traders anticipated. Now, full-year guidance has been strong, particularly in the industrial space. So the largest names like Caterpillar and 3M and Honeywell and Stanley Black & Decker have not only beaten the guidance, but they've also raised their full-year estimates. GE and United Technologies both reaffirmed their full-year outlook. That's a huge relief to the markets because traders have been concerned because stocks are expensive by historic standards. Analysts have been modeling notable increases in earnings for the rest of the year based not on the Trump tax cuts, but on an improving global economy. That's the key. And right now, the first quarter profits are expected to jump more than 12%. That's the best gain in 6 years, and they have similarly high hopes for the rest of the year. And by the way, this is not just the United States. Earnings have also improved in Europe. So the Stoxx 600, for example, that's the European equivalent of the S&P 500, saw earnings grow about 13% in the fourth quarter. That follows a year of declining earnings. Now, first quarter earnings are expected to rise 5.5% in Europe. That would be the strongest in 5 years for that quarter. Now, we'll see if this is enough to keep the stock market near record highs. That's the key. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Still ahead, as Americans continue to borrow money, how much debt is too much debt?
The number of homes that were under contract dipped in March. According to the National Association of Realtors, pending home sales fell 0.8% from a month earlier. The decline may be due to both the lack of inventory on the market and also the increase in home prices, which have risen far faster in recent years than Americans' incomes.
President Trump says the North American Free Trade Agreement, NAFTA, will be renegotiated, not immediately terminated. The president decided against abrogating the trade deal after speaking to the leaders of both Mexico and Canada. He added that terminating the deal would be a shock to the system, but that if a fair deal cannot be renegotiated, NAFTA will be terminated.
One day after the White House released its tax outline, investors want to know what impact, if any, it could potentially have on economic growth. Steve Leisman did some digging.
The president's tax cut plan immediately launched a vigorous debate among economists. What will it cost and how much growth will it generate? But the president's team threw a wrench in the argument. It didn't release enough info to really estimate the effects, and it did so on purpose.
There's no way to score what we put out yesterday. And we did it on purpose, not to try and hide the numbers, but to say, look, this is the first discussion.
To score the revenue effects of a tax cut, the models need the actual numbers, most of which were not provided by the Trump administration. And they need to know how the cuts are paid for to gauge the deficit and interest rate impacts. In the debate, one side argues that tax cuts spark massive growth, so the tax cuts nearly pay for themselves. Another says the effects will be modest at best and will create huge deficits.
This is a subject that's been enormously studied by economists of both sides of the aisle. We've got lots of experience with broad-based tax cuts, the Bush tax cuts at the beginning of the last decade, the Reagan tax cuts in the 1980s. And you can argue about whether on balance they were good things or whether they were bad things, but there is no serious reading of the evidence that suggests that they came close to paying for themselves by stimulating economic growth.
The administration essentially acknowledges this. In announcing the plan, they said they can bump up growth to 3%, but that won't be enough to pay for the cuts.
This will pay for itself with growth and with reduction of different deductions and closing loopholes.
The Treasury Secretary said 100 people in his department have been working on scoring the plan. But the administration has chosen for the moment not to release any of that work, which would help the public and investors score the tax plan for themselves. For Nightly Business Report, I'm Steve Leisman.
According to Northwestern Mutual's 2017 Planning and Progress Report, Americans are besieged by debt. 4 in 10 Americans say they spend nearly half of their monthly income paying down debt, while more than 1 in 10 say their debt exceeds $100,000. Chris Christopher is Director of Consumer Economics at IHS Markit, and he joins us now to discuss why consumer debt is where it is and why it is rising. This study, Chris, excludes, as I understand it, most forms of mortgage debt. So what we're talking about here is student, consumer, auto, and other.
Yes, and not all type of debt is the same, and that's the key question. I mean, student debt is a lot different than you see on credit card debt. It's more focused on a particular age cohort. So it's an interesting study. However, you have to look at each piece of it very carefully.
Yeah, and student loan debt tends to be at a lower interest rate, certainly, than credit card debt. How worried are you, if at all, about the amount of credit card debt that Americans are carrying?
The level of credit card debt has been sort of, it did fall during the Great Recession, and it is creeping up. However, when you look at, the employment numbers, consumer confidence, wage growth, it is sort of on pace with that. However, student loan debt and student loan defaults, that is a worrisome issue, and that's very focused on a certain age cohort, and they are sort of bearing the burden of that.
I would also guess that auto loan debt, which has now gotten out to, so it's not just a 3-year loan anymore. Sometimes it's a 5, 6, 7-year loan to keep the monthly payments down. That can be a burden as well. What's the best advice that you would give someone who is struggling with these kinds of debts?
Well, I would tell everyone to sort of live modestly. Make sure you go to school, of course. Be a good student. And of course, don't overspend. Try to live within your means, or if you're buying that automobile, buy an automobile that's sort of, you can sort of afford, and don't be tricked by, stretching out the payments, therefore you sort of, under the false illusion that you don't have to it's not that expensive.
Very quickly, we have about 30 seconds left, Chris. The auto loans that are being made, as I understand it, to riskier borrowers. Is that a danger on a systemic level, kind of like what we saw with the housing crisis, where you had subprime mortgages? Are we seeing an increase in subprime debt in the auto sector?
Well, what we're sort of seeing, this is data from the New York Fed, is that auto loan debt has surpassed $1 trillion overall. It is increasing, and the defaults are increasing. In addition, the credit scores of those who are getting these new loans, the originations, has been lower and lower. So that is one concern. However, it's not like a housing bubble of any sort. You don't buy a car and then try to flip it and all that kind of stuff. It is used for a purpose, but it is a concern, and we're watching it very carefully.
All right, Chris, thank you very much. Chris Christopher with IHS Markit.
Under Armour tops earnings estimates, and that's where we begin tonight's market focus. The athletic footwear maker posted a quarterly loss, but the street was expecting worse. Overall sales rose as higher wholesale revenue and strong demand for Under Armour's apparel lifted results. The company also said it's confident it will meet full-year financial targets. Shares popped nearly 10% to $21.67. Ford's profit fell as the automaker said earnings were hampered by recall costs and investment in future products. Still, the results were better than expected. Revenue rose, thanks in part to an increase in average transaction prices in the U.S. Nonetheless, shares fell 1% to $11.47. UPS's better-than-expected results were helped in part by a rise in e-commerce deliveries. The company said all segments contributed to a solid quarter.
Overall, for the quarter across the enterprise, we're pretty happy with where we're at right now. In the international business, we saw exports grow at the highest we've seen since the recession at over 14%. And then on the supply chain and freight business, we saw profits up 22%. And then in the U.S. business, revenues were up about 5%.
UPS shares rose 1% to $108.83.
The railroad operator Union Pacific said an increase in coal freight volumes helped it post an increase in profit that beat estimates. Revenue also stronger than expected, and the company said it expects shipping volume to rise in the low single digits this year. Union Pacific shares up 3% to $113.53. Starbucks said global same-store sales grew, but it wasn't at the clip analysts expected. The coffee chain did say it's confident that future sales would be driven by a number of new products in the pipeline. The company disappointed the street with its latest quarterly revenue, while its earnings were in line with estimates. Shares initially fell. After hours, they ended the regular session down a fraction at 61.30.
Coming up, not coming to America, why fewer people are booking flights to the U.S. American Airlines wants to increase pay for its pilots and flight attendants. The airline said the employees will receive, on average, 5 to 8% increases in hourly pay. The adjustment matches rival carriers, and it comes mid-contract. The company also reported solid quarterly earnings results and deferred delivery of several wide-body jets. But the pay increase that could cost the company about $1 billion over 3 years worried some shareholders, and it pushed the stock lower in trading today.
Meantime, United Airlines has apparently reached a settlement with the passenger who was dragged off his flight a couple of weeks ago. The sum, not surprisingly, not disclosed. Take your own guess there. The passenger, Dr. David Dow, was hospitalized after he was forcibly removed from the plane to make room for transiting crew members. That's not the only thing the airline is doing as it continues to grapple with the fallout from the incident. Phil LeBeau has more.
With the video of Dr. David Dow being dragged off a United Airlines plane still swirling on social media, United Airlines is hoping new policies and more apologies will help mend the company's battered image. For starters, it's changing how it treats overbooked flights. Passengers will now be offered up to $10,000 to voluntarily give up their seat. And once a passenger is on the plane, they cannot be bumped. While United says it will reduce the amount of overbooking, CEO Oscar Munoz says the practice will continue because it helps the bottom line.
The reason we do it is to fill up the plane, plain and simple. And if we didn't fill up the plane, I think the economists in the world all talk about the fact that prices might indeed rise.
Munoz admits United has not determined how much this controversy has cost the airline, but it's clearly sparked a change in the industry. Delta has already increased how much it will offer passengers to give up their seats, and Southwest Airlines says it will soon stop overbooking flights.
We're seriously reconsidering that practice, and I've made the decision, the company's made the decision that we'll cease to overbook going forward.
For United, the lesson is clear. Customer service must improve.
Our shared purpose in our company is about connecting people and uniting the world, and that came from a lot of input from a lot of our family here at United. Connecting people, simple word. What they mean is connecting you to the things that are important to you, regardless of where you're sitting.
United is implementing some of these changes immediately. Others, like more training for gate agents and flight crews, will start over the next couple of months. Phil LeBeau, Nightly Business Report, Chicago.
And while United is dealing with issues here at home, the travel airline industry is also dealing with the drop-off of visitors to the U.S. According to software company Adobe, people booking flights from overseas destinations to the U.S. fell 6% in the first quarter. What's keeping them away? Hannah Sampson joins us. She's the associate editor at Skift. Nice to have you here, Hannah. Welcome.
Good to be here. Thanks.
I also noted from the Adobe survey that an additional 26% dropped their plans or changed their plans for coming to the United States the week that the travel restrictions were announced in February. So it seems as though they have had quite a chilling effect.
There was a lot of disruption, especially around those few days around the travel ban, because it was just so tumultuous. It was such an uncertain time, and the images of protests at airports and people being detained was really very chilling to travelers all over the world.
Are people also worried about the strong dollar?
I think that is a big underlying factor, and it's been a problem for the U.S. for the last more than a year. They've been dealing with the fact that it's a little more expensive for international travelers. So they had to work that much harder to get people to part with their vacation dollars. And now with that kind of extra problem of having an unwelcoming message, it's presenting some new challenges.
There are a couple of states you point out that are trying to combat that a little bit. They're putting out PR campaigns of a welcoming nature. Does that tend to have an impact or not?
Well, I mean, we'll see. It's only been not that long since LA and New York City specifically started to roll out these messages that said, you're welcome to be here. We want you to be here. They show people speaking different languages. They kind of highlight the diversity of those destinations and really drive home the point that diversity is welcome, at least in those cities, even if the U.S. altogether isn't sending that message.
Is the fall off in demand for U.S. travel resulting in canceled flights by big airlines?
We have seen at least one international airline, Emirates, pull back the number of flights that it's flying to the U.S., and they're tying that directly to Trump's policies, both the travel ban and the crackdown on in-cabin personal electronics. You know, you have to stow your laptop in checked luggage, and that's inconvenient. And both of those things are really contributing to a drop in demand. So that airline is taking the action they have to take.
Right. Travel for business purposes. Now, that equipment issue certainly hit business travelers very hard. But the survey also said that 37% of managers anticipate a drop in business travel, and 47% of Europeans said they expect a reduction.
Yeah, so that's something that especially the business travel industry is really concerned about right now. They have Europeans who are saying, we're going to plan our meetings somewhere else, in other countries. So that's a big concern for them.
Thank you, Hannah. Hannah Sampson with Skift.
Thank you.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great evening. We'll see you tomorrow, Friday.